Marc Faber joins in to talk about what has been a very, very difficult run for emerging markets. Marc, good to have you on the show. What have you made of the underperformance in emerging markets too far, and is it now beginning to look like a crowded trade, this EM versus developed markets debate?
Well, basically, we had a massive outperformance of emerging economy stock markets between 2003 and a few months ago vis-a-vis the US, and investors were by and large overweight emerging stock markets and underweight the US. They're still underweight the US. And so when the talk about inflation came up, I'm not saying it's justified or not, but when it came up, it gave investors an excuse to sell down their holdings in emerging markets and to move some money back into the United States.
Morning, Marc. Do you see most of that trade as having played out, or do you think emerging markets have not bottomed out yet?
I don't think that emerging markets have bottomed out, but I think it would be now late to sell emerging markets that in many cases are down 20%, and many stocks, good companies, are down 30% from the recent highs, and then buy the US stock market, because the US stock market has now doubled from its low. In other words, there are only 3 occasions in the last 100 years when the stock market in the US doubled within 2 years. One was in 1934, coming off a very deeply oversold condition in 1932, and the other one was in 1937, and after 37 and 34, the 12-month return, both were negative. So I would say I'd be a little bit careful here to just buy the US, because investor sentiment is very positive, the volume has been relatively sluggish, and the market is extremely overbought by any statistical model.
What about India? If your call is that emerging markets have not bottomed yet, what would you do with India at 18,000 Sensex? What downside do you see here?
Well, I think I was interviewed not long ago, or 2 months ago or so, and I think the downside is around 15,000. But you understand, many things can happen in the world. I think investors have been very complacent about the events in the Middle East. Now, I'm not suggesting that it will necessarily spread to the Emirates, to Qatar, and to Saudi Arabia, but there's always possibility of some further bad news coming out of the Middle East, which would then, in my opinion, drive up oil prices, and obviously rising energy prices would be a negative for the global economy, for the US economy, and also for India.
What kind of upside risk would you say exists for crude prices themselves, Marc?
Well, I mean, the upside, if you look at cotton and if you look at some other commodities like copper, then obviously oil prices could go up substantially even from this level. I don't think that oil is expensive compared to other commodities or compared to other goods prices in the world. But that would obviously depend on some political problems, some interruptions in oil supplies, or a possibility is, of course, that the global economy experiences some kind of a crackup boom. A crackup boom is a boom that is driven by artificially low interest rates, easy monetary policies, and debt growth. The private sector debt growth has slowed down, but it's turned up again. And at the same time, we had, of course, a huge expansion in government debt that should not be forgotten. And so these crack-up booms, they don't last, they're not sustainable, but they can last 6 months, 1 year, 18 months, and then a renewed setback occurs in the global economy.
At what point would you consider the fact that emerging markets at any rate may be in a bear market now and not just a running correction in a bullish phase?
Yeah, that is a very good question. Whenever a market turns down after an extended uptrend you don't know for sure whether this is the beginning of a bear market or whether it's just a correction in an uptrend. My impression is that this correction could last somewhat longer. And then we will have to watch the rebound, whether the rebound can bring new highs or not. If it fails to bring new highs, the likelihood of a bear market then manifesting itself is quite high.
But if you look out 6 to 9 months, Mark, do you see global markets moving in this kind of opposite directions? Like last few months, it's been in opposite directions. Developed markets have moved in one direction and emerging markets in another. Do you see any synchronous movements happening sometime late in 2011, or do you think it will be one versus the other?
Well, my view is that the U.S. market will eventually join the emerging markets on the downside because, if you take a bearish view about emerging economies, you can't be too optimistic about the U.S. because for many U.S. corporations, 50% or more of their profits come from emerging economies. And my main concerns are these. First of all, I think that not all is well in China, and that if the Chinese economy slows down more than what analysts expect, we could have a downdraft in commodity prices, and all the warrants on China, whether it's Brazil, Australia, or Indonesia, would get hit quite hard. Secondly, I think that the geopolitical tensions in the world are increasing. In particular, if I were in India, I would be concerned about events that are now occurring in Pakistan, Afghanistan, and this can also have an impact, obviously, on the valuation of equities. But we shouldn't forget that all the central banks in the world basically only know one thing, and that is to print money. And when things will get bad, they'll print more money. If they get worse than bad, they'll print more money. Independently, whether that is the Bank of China or the Reserve Bank of India or in the US, all the central banks will keep interest rates artificially low, and they won't increase them to a level where inflation adjusted, they are positive. Be overly negative about assets, and corporation stocks are assets like commodities or real estate and so forth. I would be very concerned about the bond market.
Thanks, Mark. Appreciate your thoughts as always. Thanks for taking our call today. That's Marc Faber with his view on emerging markets. He doesn't think we have a bottom in place yet.